All right, so last year, Jay Powell warned the nation of pain. Remember, he said pain. That's what we remember from Jackson Hole. And it was, of course, mostly talking about large job losses associated with aggressive Fed tightening. And then there's quantitative tightening and of course, raising rates. But a year later, most economists are describing this job market as either strong or robust. No one is talking about pain. I mean, UPS truck drivers earning $170,000 a year. Then last night we heard American Airlines, they agreed to a nice big contract. Their pilots did 46% cumulative pay raise, retirement contributions over the next 4 years. And the UAW folks, they're teeing up a big one. They want a lot of money or they're going to go on strike September 14th. So we're going to keep seeing that kind of stuff happen. In the meantime, it's all workers who are kind of licking their chops these days for a pay raise. So yesterday from the New York Fed, we learned that the floor for wages for the American worker keeps climbing to record highs. Now we're close to 79,000. That's the yellow line here. That's what a person is saying, the so-called reservation wage. They won't take less than that. If you want them to come work for you, that's the minimum a worker will take, right? But here's the problem. Small and medium-sized businesses are saying, no mas, no, we can't do it anymore. Let me give you an example. So in 2001, this is where wages were for transportation workers. 2020, they went up huge. Guess where they are now? Bam, look at that huge reversal. It's everything. 2023, all wages are coming down, at least with respect to the only one who went up, animal care. So if you're a dog walker, fine, you may be making more money, but small companies, size companies are saying we can't afford it anymore. I want to bring in Macro Policy Perspectives founder and president Julia Coronado. All right, Julia, listen, there's all these things about you could squeeze so much out of this and that. Is there so much they can squeeze out of these businesses? Have they reached the point where they're saying we just can't afford to pay these wages anymore?
Well, you're highlighting what is more of a tug of war now. You've got businesses that are facing, slower top line growth, looking for ways to save money and preserve those margins, and workers who are trying to catch up with the last burst of inflation. So there's more of a negotiation going on right now. Actually, what the data overall show is that, as sort of your last data point pointed out, wage growth is slowing down. Wages are still rising. They tend to rise over time with inflation. And they're just slightly beating inflation now. But the pace of wage increases has slowed down. Mm-hmm. Another benefit for businesses right now is that turnover is also declining. Yeah. So one cost of labor is the wages you pay. Another cost is the need to replace people and hire and maintain a hiring machine when there's really high turnover. The fact that turnover has come down is a relief of cost pressure on companies.
Now, I know you're in the no hike camp, if I remember our last conversation. The thing is, Jay Powell has really spoken out loud. He wants to not, as much as people say he wants to be Volcker 2.0, I think he wants to avoid being Arthur Burns 2.0 even more. And so, yes. Apollo put out this great chart, a sort of CPI now versus CPI in the 70s, and sort of a cautionary tale, if you will. If Powell lets up too quickly and takes that victory lap, well, we know in the late 70s, inflation rocketed higher again. How much is this, do you think, in the back of his mind as he speaks to us on Friday?
Very much in the back of his mind. I think it's a delicate task to pivot from we're just going to keep raising rates till something breaks to a message that's more nuanced and focuses on we're not going to cut rates anytime soon, but we're kind of where we need to be, and we're going to hold here for a longer period of time until inflation has sort of definitively come down over 6 to 12 months. So I think that's what the Fed has in mind. It's not the pain message that we had last year. Last year, markets were second guessing the Fed. Right. Will they go higher? Will they hold rates higher for longer? The Fed has demonstrated their will to do so, and now the markets are fully pricing it. You've seen that in longer term rates and mortgage rates that are at cycle highs right now, at multi-decade highs. And so the Fed doesn't need to correct that. It's where they want it to be, but they also don't need to keep hammering a painful message either.
So this meeting is on Friday is about global structural shifts, right? And one of the things that's new is sort of energy or energy policies around the world. This is from the ECB. I found it to be fascinating because they're talking fossil inflation, climate inflation, and greenflation. This one stands out to me, Julia, because we're pumping in billions and billions and billions of dollars to try to reach this green agenda, which, by the way, even when we reach it, it may still be pretty expensive to maintain. How does the Fed start to add in these sort of nuances that didn't exist before?
Well, look, the Fed is very careful to try and not target a particular price or group of prices. They usually, when they look at trend inflation measures, they're excluding food and energy because those items tend to be so volatile. They go up, they go down. And so really the Fed is looking at the broadest scope of inflation pressures that consumers are facing across the entire basket of goods and services. So I don't think that they are going to be focused on any particular industry or sector. They're going to be looking at the broader sweep of inflation and is it starting to cool down? We've seen some hopeful signs, certainly in rent inflation and car inflation. It's not like prices are falling, but they're not going up. Some prices are actually falling, like used and new cars. But, again, they're not going to target that either. That's
Right.
one price. They're going to look at the broad set of prices and how they behave, not over 1 month or even 3 months, but over 6 to 12 months.
Great stuff. Julia, we covered a lot. Thank you so much. I appreciate it.
My pleasure.